Assalamu alaikum, boys and girls. So, as you can see, this is a final revision for SBL March 2026 attempt. By the way, I am Zeeshan, the tutor of strategic business leader. Right. So, I'll be giving you the final revision based on the expected top questions according to a Mercy company pre-scene. Right. Um, so, without wasting time. Let us start with it. Uh, one of the expected top questions you may get is from the strategic analysis, right? And here we go. We have three-part model for it, right? In three-part model, what we have strategic analysis, we have strategic choice, and strategic implementation. Well, as far as the strategic analysis are concerned, right, it considers the impact of internal and external environments on the strategy of an organization, which is also known as strategic position. As far as strategic choice is concerned, it involves identifying the best strategies, best strategies of for an organization and the methods by which those strategies will be pursued. What is implementation? It deals with the practicalities, with the practicalities uh, of forming of forming and implementing strategy. Okay, and it is also known as uh, refer to a strategy into action. Although it may seem logical that these three steps should be undertaken in a linear fashion, that is analysis, choice, implementation, right? Analysis, choice, and implementation. The model recognizes that in practice, the development of strategy is not linear. For example, analysis of the strategy can only take place on a strategy has been tried. The circles emphasizes that each stage may take place at any time or iter, uh, iteratively as well, right? So far, so good. Well, strategic analysis concerned with identifying strengths, weakness of the business. This is useful in recognizing whether particular strategic choices could be followed or whether action can be taken to neutralize any weakness, right? For external purposes, right? For external purposes, what we will do, we will apply PES2. Analysis can be used here for macro environment. Also, Porter five forces model can be used to analyze the competitive nature of an industry, whereas analysis of the internal environment is used to determine whether the business has the right strategic capabilities, culture to achieve its strategies and objectives, right? Um, Also, SWOT analysis is a tool that can be used to summarize the analysis of strategic position of an organization, right? SWOT S stand for strengths that it does well or things that do not do well. Weakness things it does badly or it thinks lacks. Internally, opportunities, events, or changes that can be exploited to organizations. Advantage, threats, events, or changes that could be defended against. Right. So, um, further, as far as the strategic choices are concerned, strategic choices involve deciding which direction of an organization should pursue and how to proceed in that way. For example, decision to diversify into particular product. Strategic choices may deal with one or more of the following: corporate level strategy relating to portfolio management questions, which business unit should be held, business strategy for competing with a particular business area, internal strategy looking at whether to diversify into international markets, and if so, acquisition and alliances as methods by which organization can pursue their strategies. Okay. Uh, as far as implementation is concerned, strategic implementation involves actioning the strategy after an evaluation of the strategic options. Decisions are made on appropriate corporate structures, methodologies for implementing strategies may be used. Okay. So as far as the pastel framework is concerned, PESTEL, that is, political, economical, social, technological, ecological, and legal, right? So, political factors includes, government stability, taxation policy, foreign trade, regulations, social welfare policies, economical factors include business cycles, GNP trends, interest rates, money supply, inflation, unemployment, disposable income. As far as the social or cultural factors are concerned, it includes uh, population demographics, income distribution, social mobility, lifestyle changes, attitude about work and leisure, level of education. Okay, as far as technological is concerned, factors are concerned, it is government spending on technology or research, government and industry focus on technology effort, new discoveries. Ecological includes, environmental protection laws, waste disposal, energy consumption. Legal includes, competition law, employment law, health and safety law, etc. Right? Keep in mind that do not mix political with legal. Many students do mistake in the exams that they do mix these two, right? Or they use them interchangeably. Political is not about or legal cannot be mixed. It's legal is only about the laws, right? Whereas uh, political factors has all of the factors which I already discussed. Okay, so far so good, and let us now proceed further. Just a second. So, Porter's diamond. When we will be analyzing the diamond, Porter's diamond considers why some nations are more competitive than others, and why some industries within nations are more competitive than others. Porter's does not believe that countries as such as are competitive, but rather than the conditions within a country may help business to compete. Porter identified four broad categories or attributes of a nation that contribute to attaining competitive advantage for an industry. He suggests that each of these attributes can be affected by government policy and change, a random and unplanned occurrence, and those are, factor conditions, demand conditions related and supporting industries, strategy, structure, and rivalry. Now, uh, favorable factor conditions include Porter classifies a factor of production into two types, the non-key or the key. Non-key or general use factors include, unskilled labor and raw materials, which are available on to all non-key factors. Non-key factors like unskilled labor, raw material which is available to everyone, right, or all companies and are therefore not a source of competitive advantage. Then we have a key factors, or you can say the specialized factors, uh, factors which are created by specific firms through investment and innovation. These cannot be easily replicated and are therefore valuable source of sustainable competitive advantage, right? So the key factors are those which cannot be replicated easily, right? What are the examples of key factors? Innovative products, services created through research and development, intellectual capital created through training and talent management, high productivity achieved through business process re-engineering, right? And Porters therefore argues that nations with the abundance of non-Q factors, example, natural resources tend to become inefficient and lose competitive advantage. Nations with scarce resources are forced to become efficient and innovative, generating valuable key factors. Then we have demand conditions. If a nation consumers have a high expectations, business will be driven to produce high quality products at fair prices. So leading to a competitive advantage that can be exported globally. For example, demand of sophisticated wine drinks in France lead to wines and admired globally. So business also, yeah, business forces to produce high quality products like Korea uh, producing Samsung, right? Like Japan producing Honda cars, etc. Honda or Toyota cars. Then we have strategy, structure, and rivalry. Well, in strategy, structure, and rivalry, here, it involves strategy. Strategy, like countries whose capital markets take a short run outlook, such as US, will tend to be more competitive industries in which investment is short term. For example, the computer industry, countries with a long run outlook, for example, Switzerland will tend to be more competitive in industries in which investment is long term, for example, pharmaceutical industry. Then we have a structure over here. Some countries may be oriented towards a particular style of management. Those countries will tend to be more competitive industries for which that style of management is best suited. And then we have rivalry. Porter argues that these intense competition drives innovation. Okay. Then we have related and supporting industries. The presence of competitor suppliers and related industries in one location provides competitive strengths. This usually occurs at a regional level rather than at a national level. For example, for example, Silicon Valley, Detroit, Canary, etc. So far, so good. And I hope it is clear till here. Uh, so far, so good. So VRI and model strategic capabilities provide a firm with a competitive advantage. The question is how long can the business enjoy the competitive advantage? So capabilities may be copied by competitors. Demand patterns in the market may change. So JSNW develop a VRI and model for assessing the strategic capabilities of an organization to determine whether they can lead to a sustainable competitive advantage. VRIN stand for value of strategic capabilities, rarity, uh, inimitability, non-substitutability. Okay. Now, the strategic capabilities value is they enable an organization to achieve a competitive advantage at a cost that allows an acceptable level of return. So, there are four aspects of value. Number one, you know, does the capability enable organization to take advantage of opportunities and neutralize threats? Okay, enable the organization to take advantage of opportunities or neutralize threats is the capability valued by customers. This may seem like an obvious requirement, but in reality, many firms spend time developing capabilities that they believe are important, but customers do not, right? So, next question is, do the capabilities enable organization to provide product or service which competitors can't or cannot, right? And the last question to ask in value is, does the cost of capability enable organization to make reasonable level of return, right? So now the next is rarity. Rarity is concerned with whether or not organization has capabilities that competitors do not have or are rare. So whether or not organization have capabilities which competitors don't have, or it's rare, right? This might include resources such as patents or intellectual capital. It is also important that their rarity is sustainable. This means it would not be feasible for competitors to obtain similar capabilities. Then imitability. Uh, Competitors find it hard to copy, right? To copy, to imitate. It is normally associated with competitors rather than resources, as resources can generally be more easily by the competitors. Imitation might be difficult if the capabilities are based on business processes that have developed over time, where the complexity of the links between the various business processes make it difficult for competitors to imitate. Okay. Uh, Next is non-substitutability. Farmers develop capabilities that are difficult to imitate and are rare. It may still the risk of substitute. So here it means products For services, substitution is where new product and services are developed that meet the need from customers in another way. Right, so far so good. And I hope it is clear till. Okay, now we will be discussing about the risks area. So risk and uncertainty are the inevitable aspects of doing business. All organizations face risk, right? Here are and the useful definition of the risk is the possibility that an event will occur and adversity affect the achievement of objectives, right? So traditional risk management focused on operational risks. For example, fire, theft, floods, and the most common way of dealing with these ways to ensure against them. Risk management was not an activity that would concern senior management. But during last few decades, more importance has been placed on enterprise risk management, and it is recognized as a strategic issue that should be overseen by the board of directors, possibly through a risk committee. The underlying principle of OZO or ERM framework is the very every entity exists to create value for its stakeholders. This value can be preserved or eroded by management decisions. Okay. So, who has the responsibility for risk management now? So, the risk management strategy is the approach taken to identify, assess, and manage risk. A risk management strategy is the responsibility of senior management. It recognizes the significant risk that risk can play on the achievement of an organization goals. In fact, that some risk threaten the existence of the organization. A risk management strategy typically uses a framework such as COSO. Now, what are the relationships with the organizational strategy? So, what are the relationships of this with organizational strategy? Organizational strategy concerns the actions to shape long-term direction of organization. Risk management strategy, organizational strategy should be rated because the objectives of the organization set out during the strategic plan stakeholders of the organization. This is then used to define the risk appetite of organization. Okay. Then we have during the strategic planning process, management need to ensure that strategic option chosen are acceptable given the risk appetite of the organization stakeholders. The risk profile of each strategic option needs to be assessed as well as the effect it will have on the overall risk profile of the organization. Okay, then we have strategic risk management. Ensure that the probability of to fail achieve its stated business objective keeps at lowest level. Okay, then strategic planning may be based on assumptions uh, about what events will occur, Risk management can provide insights into the sensitivity of the achievement of the objectives to changes in the underlying assumptions to help managers make better strategic decisions. Okay, so far, so good. So, what elements they should have? So, a risk management process should, at the very least, incorporate the following elements, right? So, first, we have to look at threats to achieve corporate objectives, right, and identify them first, right? Then, after identifying them, we have to evaluate them. We have to analyze them. We have to assess them. Then manage, approach, and take the action against them. And then again, monitor, review, monitor them, review them, give the feedback about them, and if you then identify further risks and all, right, and repeat the process. So far, so good. Then we have enterprise risk management, often tested in the past as well, and even this time, this topic has the chances, right? So, enterprise risk management. It is the culture, the capabilities, and practice integrated with strategy, setting and performance that organization rely on to manage risk, on to manage risk is creating, preserving, and realizing value. So, as per COSO, the COSO framework, the fundamental concepts, what are the fundamental concepts? The fundamental concepts of ERM are Well, ongoing continuous process, a way to help create and preserve value, include practices that management put in place to manage risk and aid to make better decisions. Now, what are the advantages of them? Well, the advantages are increase the range of opportunities by considering both the positive and negative aspects of the risk, increase positive outcomes and advantages with reducing negative surprises, respond more proactively to risk, enhance ability to identify and manage entity wide risks, reduce performance variability. So far, so good. And I hope it is clear till here. Right. Let us discuss about the risk categorization. Well, we have various risks, right? Uh, we have strategic risk, we have operational risks, market related risks, and credit related risks, right? So each of this may fit into other categories. For example, common business risks such as the risk that sales will deteriorate, sector specific risks, uh, country risk. Okay. So as far as the strategic risk is concerned, also known as enterprise risk, entities unable to achieve one or more of its objectives. This may be due to poor selection of strategic options, poor management, execution, or other factors. Right, the risk to an entity strategy are the threats or opportunities that materially affect the ability entity to succeed or even survive. Right. Um, then we have operational risk. Operational risk. It is a risk of loss due to failed internal processes, right? Operational risks are associated with operational management related to day-to-day activities of the organization. People risks include fraud and theft, breaches of employment law, loss of personnel, and actions of unsupervised employees that may lead to financial loss. Processes the risk that the business processes are not operating as they should. System risk of failures of the systems, including risk associated with developing and implementing new systems. External events and any external events that disrupt the operations of an organization, such as natural disasters, utilizes failures and strikes. Okay, so far so good. So far so good. Now, then we have sector specific, industry specific risk within any sector. For example, extractive sector, there will be different industries. Example, oil and coal. Each industry faces different risks that may change even within a particular industry. Mining risk, example, depending on extraction, deep sea or open cast. So industry specific risks affect only uh, affect certain business sectors. Then we have credit risk. That certain people, the payers will not pay the company, and obviously the company will face those losses due to the bad debts, right? So market risk sometimes also referred to as systematic risk, exposure to uncertain market value. Market value of an asset, liability, investment portfolio, or derivative contract linked to asset or liability held. It is a risk that value of an investment or liability will decrease, increase due to moves in market factors, right? It may be due to change in equity value, interest rates, etc. Right? Then we have uh, credit risk. As I said, loss face due to bad debts, right? Then we have then we will have liquidity risk. There are three aspects of liquidity risk. Risk that an entity will encounter difficulty in obligations associated with financial liabilities. That is, the risk of bad debt. Then risk of paying cash, risk that an entity will not be able to raise cash. Sorry, not raising cash. right? Will not raise cash either from its shareholders or third parties, for example, banks. Risk of premature or forced sale of assets at a market loss to raise necessary funds. Okay. Uh, then we have technological risk. Now, what are the technological risks? Uh, risk of not recognizing potential of technology, including change and emerging technology. Such technology may be backroom, for example, executive information systems, decision support systems, computer aided design, or front room, example, operational systems, production systems, procurement systems, supply chain systems, customers management systems, etc. Okay, then we have legal risks. Legal risk, that is, risk of breaching applicable laws and regulations, sometimes referred as compliance risk. Such laws may be general, health and safety, company law, financial statements, or there may be specific. Typical legal risks include competition law, data protection, product recalls, etc. Then we have health and safety risks. Many occupations carry the risk of serious injury or even death. Mining, firefighting, deep sea diving. In many jurisdictions, health and safety covered by legislation. Thus, breaches will be subject to criminal proceedings, fines, and in extreme cases, business closure. Accidents and illness can costly, right? So, so criminal proceedings can happen, fines, or in extreme business cases, business closure. So these are the risks related to them. So far, so good, and I hope it is clear till here. Uh, Sustainability risk, environment risk concerns the damage to entities, activities caused to environment, loss of quality, result of environmental degradation. Quality of life can be affected, right? So far, so good. Now, e-business models. E-business models, the organization of product, service and information flows and the source of benefits for suppliers, which lead to revenue. An e-business model is the same traditional one, but used in the context of the online presence. The following is a list developed by Michael Rapper, which includes brokerage. Brokerage are the market makers which bring buyers and sellers together and facilitate transactions. Usually, a broker charges a fee for commission for each transaction. It enables uh, advertising. The web advertising model is an extension of the traditional media broadcast model. The broadcaster, in this case, a website provider content often for free and services such as email, blogs, etc. Then intermediary data about consumers and their consumption habits are valuable, especially when the information is carefully analyzed and used to target market campaigns. Then we have merchants, wholesalers, and retailers of goods and services. Sales may be made based on list prices or through an auction. A virtual merchant is a retail merchant that operates solely over and he conducts both sales and distributors over the web. Manufacturer Manufacturer relies on the power of the web to allow the company to reach buyers directly and thereby compress the distribution channel, eliminating the middleman. The manufacturer model can be based on efficiency, improved customer service, and a better understanding of customer preferences. Then we have affiliate. Website often provide links or selling opportunities on behalf of other websites that their users may be interested. For example, travel website contain links to hotel booking websites. Then we have community. The community model involves establishing online community schools, networks, and online self-help groups. Examples, revenue may be based on voluntary contribution. For example, Wikipedia sales of ancillary products or even advertising. Then we have utility. The utility or on-demand model is a pay-as-you-go approach, unlike subscriber on-demand model is based on actual usage rates. Right. So far, so good. I hope it is clear till here. E-business can be considered in five-layer model, right? And what are those? Firstly, e-business services, application layer, system, software layer, transport or network layer, storage or physical layer, And then we have content and data layer, right? So, e-business application layer, customer relationship management, supply chain management, data mining, content management systems, web browser. Then we have system software layer, web browser, server software, standards, networking software, and database management systems. Okay. Transport or network layer includes physical network transport standards. Then we have storage and physical layer, that is, a permanent magnetic storage on the web servers, or optical backup, or temporary storage in memory. Then we have content and data layer, web content for intranet and internet sites, customer data, transaction data, click stream data, right? So the layer one, e-business services layer, consists of the e-business IT applications that create value for the user of the system. Layer two, software layer, includes the user's web browsers or web app or a mobile app application and web server software, as well as the networking software and DBNS. Trans- Layer 3, transport or network layer, includes the organization physical network and the internet network. Standard for data transport over the internet is TCP/IP. Layer 4, physical storage layer, is where the information is stored. Right. So far, so good. And I hope it is clear. E-branding. E-branding. Now, what is e-branding? Brand and image of a business are vital to its success. Strong brands can generate customer trust, which is particularly important in e-commerce, where there are often concerns about privacy, security, and not being able to touch a product. Effective brands increase business revenues. Okay. Uh, well, they increase customer loyalty as customers trust them. They may be used to differentiate the business from its competitors. They reflect the image of the business to customers and attract customers who feel empathy with that image. Okay. Well, e-branding concerns with the branding of a company, products and services online, right? Through online services, right? So, as far as online versus traditional is concerned, uh, Traditional brands were built up using traditional methods such as print and TV advertising. Online brands are managed using following methods includes website creation, search engine optimization, which is also known as SEO, to ensure the website is found easily when customers search for the product or services. Blogs that say complementary things uh, about the business, managing the presence of the business in social media, email campaigns. The internet providers two-way dialogue between the business and its customers affects the brand. So far, so good. So now, supply chain management. Supply chain management. So it is a management of flow of goods and services from point of origin to point of consumption. Supply chain management is the active management of the activities in the value chain. It recognizes that many organizations are involved in the making of products or services that are provided to final customers. Supply chain activities include product development, source production, and logistics. Right. So far, so good. And I hope it is clear till here. Uh, Further, financial analysis in SBL right now. Here, what you need to look at planning is a vital for achieving a well targeted answer. You should firstly consider how long you have to discuss financial issues, right? Uh, then, in we already discussed. Now, using the spreadsheet response option, you can use the spreadsheet response option in the SBL exam if you are carrying out a number of calculations. The spreadsheet can help you carry out calculations quicker. However, marks are not awarded in the spreadsheet. You must ensure that your analysis is compared in word response option, and each of your spreadsheet calculations is referenced and analyzed within your word answer. Remember that, right? So, as far as the discussion of results is concerned, it is never enough just to restate the results of your calculations or say that figures have increased or decreased. The receipt of your answer is looking for you to provide insights into the figures, morely stating how the figures have moved is out helpful, right? Then you have to reconsider the reasons for the results. For the calculation, have been figures change? Are the changes consistent with the results of other calculations? The implications and consequences of the results. What will happen? For example, performances continues to worsen in certain areas, right? Uh, that what you have to consider in it, and I hope it helps you. Take care. Bye bye.